Should we buy or sell corn? First off, read this disclaimer carefully. And do your good deed of the day by liking and subscribing. So corn is one of the grains, 62% are from the low, and we are at the highs. So this is the big picture here for the futures. And it's very important to just zoom back because huge rallies and crashes for corn futures is very common. So let's just look at a couple of times. Huge rally followed by huge crash. And we can see something similar if we go back here and here and here and here. Here, you had this situation. This was in 2007. Between 2007 and 2010, there was no world war at the moment. You did have the global financial crisis. You have this situation between 1995 and 1998. All of a sudden, a huge rally and then a crash. Here as well, here, and currently. So it is obviously true that the war is having an effect on corn futures. Obviously, that makes a lot of sense. Ukraine is known as the breadbasket of Europe, so it's a very important country for grains. We can also clearly see in the chart that corn futures, they rally and crash, and they have been doing that for a long time. They just have. The chart is right here in front of us. So we have definitively seen a very spectacular rally. There are some initial signs of exhaustion. We can see here that during the last weeks, the bulls have been able to try to, well, they have at least had some success in trying to challenge these levels, but they haven't been able to fully close above that high. And it would be a very important move here for the bulls. When we look here at the daily data points, you can clearly see that there's been this consolidation, and we are now flirting a bit with a breakout. And if we do see a full bore breakout, that will trigger some momentum and definitively some short covering that, could become self-reinforcing. The thing is that, there's good reason to expect some kind of price control if we do see a breakout and runaway prices, because already there is a lot of concern about food prices. And, given that obesity is one of the major problems in the West, some kind of price control combined with rationing, and there's many ways to ration. You could have like a system where you can only buy that many breads, as an example, when you are at the grocery store, stuff like that. And given the obesity rates, it's not like people would be starving. But anyway, so basically, there are ways for the powers that be to limit these runaway prices. Okay. So looking here at the MACD, the RSIs, the PPOs, we are at high levels, but we are not at like extreme levels that are like, quote unquote safe to short. Looking at the daily data points, we are close to getting a MACD buy signal, and there are people who look at MACD, so the MACD bulls they will buy if we get that, and that would be another crew coming to aid the bulls in a potential breakout. Looking here at the RSI, PPOs, we are at elevated levels that are high historically, but the issue is that we have been higher in the recent past. So this is also one of those situations where it's a bit difficult to short based on RSIs and PPOs, because the issue is where do you put your stops. So in terms of being a short seller, I think that the easier short level, I think it would be horizontal based, because in order to get like a breakout that is like 2-ish% above the current price, so that would be be a potential like a stop level. So this is another situation where we have the potentiality of a horizontal breakout. Yeah, I think I will just have breakout. So in terms of the technicals here, the thing is that the bulls, they do have a lot of factors that benefit them in terms of actually pulling off a breakout. I think the odds of them succeeding, it has increased by us having this recent consolidation, because that cooled down the weekly and also the daily RSIs to a point where it's going to dissuade some short sellers. So I think I will give this one to the bulls, but I will give it very mildly, simply just a 1. Next, let's look at seasonality. Let's look at seasonality. So when it comes to seasonality, it becomes a bit more interesting because we do have a bit of an edge here. So over the last 10 years, the seasonality is bearish. Over the last 7 years here in blue, we do see it's a bit flattish, but then it becomes bearish towards July. In green, over the last 5 years, you do tend to see some strength here towards May and then weakness towards later July. To the left here, over the last 5 years, from April to August, very clear weakening in seasonality, which is beneficial to the bears. Over the last 10 years, from April to July, August, it becomes better and better for the bears. And then we go big picture the last 20 years. So April, it does close higher 60% of the time with an average 2.6% gain. Then May, June are, 50-50-ish months. So the thing is that April is decent. So we are currently in April. So it is, of course, good for the bulls that the seasonality for the current month, it is bullish. But when we looked at the average price performance, that was more supportive of a more bearish thesis. So I do think I will actually give the seasonality here to the bears. Not like dramatically, but I do think this warrants a -3. In terms of giving the fundamentals a score, obviously the conflict in Ukraine is the major catalyst when it comes to grain prices. And also, of course, the sanctions against Russia. Having said that, we did look at the long-term chart. It is very clear that throughout, a lot of years, decades, corn moves up big and also down big. So it just does that. Obviously, the explanation in this current context is different from others, but it just seems like this is the way corn behaves. Big rallies, big crashes. I do think that the current situation is unique, uniquely bullish. So I do think I will give this one to the bulls. The problem, however, with the interesting thing about the financial markets is that it is forward-looking. So the war is priced in. Sanctions are priced in. So when we currently look at the chart, we are not seeing the chart reflecting what people think about corn prices today. We have a lot of future expectations already baked in. So it becomes this very frustrating question. How much of the future potentially bullish news that would benefit grain prices are not priced in, and how much is overpriced into the current chart? So yeah, it's messy, but I think I will give this a bit one to the bulls, but it is way more messy than people think. This is one of the reasons why you can see a stock rally into earnings, and then when great earnings come out, the stock has a correction. Initially, that doesn't make any sense, but when you really digest it, it actually makes a lot of sense because, people were buying the rumor. But when the news comes out and it is basically what is expected, and then, they run the Excel sheets, and then they find out that, oh, maybe too much was priced into the chart, then you will see the correction. But when it has finally corrected, you will see that it is actually higher than it was, like a financial quarter back. But anyway, yeah, it's just the way the market works. So here are some correlations. We have an 85% with the S&P 500. We have 94% with the corn ETF. 94%, it is strong. So it means that you can use the corn ETF as an alternative to the futures market. But I would ideally like to see a much stronger correlation. 94 is good, but I do like it to be over 95%. Yeah, in these kinds of comparisons. Okay, so we do have a 40% here with the 10-year yield positive, and minus 41% here with the dollar index. Short term, then we do have a minus 27% with the S&P 500, and 99% with the corn ETF. We do see that occasionally the correlation is rather low. I think the most likely explanation is liquidity issues. But those kinds of mispricings, that does unlock some arbitrage opportunities. So that's something to consider. But getting into arbitraging, in order to do that, you really need to look at like order books and dig a bit because you don't want to fall into the realm of trading spurious arbitrage. Okay, so we do have an 86% positive correlation with the 10-year yield and 92% here with the dollar index. So what should we look at? I think I will actually run another round of correlations. So I will do the DBA, which is the Agriculture Fund. So 90% here long term, and we do see that there's a 97% short term. So we will look at the DBA. Because what happens to the DBA is going to have a very significant impact on the corn futures. So yeah, DBA, it's been on a very strong run. So we were able to break out above the red 200-week moving average, then we pulled back and we cleanly used it as support. And then the 20-week moving average has been support throughout. Looking at the daily data points, the 20-day moving average has recently been acting as the key support level. The 20-day moving average, it is a very aggressive support level. It is very high momentum. But yeah, it's currently working, but you can see here that it's not like a very clean support level. It is more magnetic than like glue. Okay, anyway, we do have a bit of a breakout here, so that is it's bullish. But when we do look at RSI and the PPOs, we are definitively very much in overbought territory. Also on the daily data points, we are very elevated. So when you have a security that is overbought, that doesn't mean that you can't buy it, but it does mean that you need to be way more careful with position sizing. Because if you have a reading that is very rare and usually is followed by a pullback, then you are playing a bit of a risque game. Okay, so here is the relationship between corn and the DBA. Now, we do see here that the recent rally here, it is, well, let's actually, draw it in. So you see here that this rally, it is actually significantly lower than this. So we do have, so while we have seen this rounding bottoming in formation, we are still some distance away from in any kind of breakout. And this is actually a pattern that it has been repeating in the past, because if we go back here, this looks a bit similar. So we have this high here, and then you have this rally. And in this case, we did actually go lower. So let's actually go further back to see whether failed breakouts are like a thing. So if we go back here in 2014, 2015, so here we had these highs, attempted breakout. Well, at least we had a rally that was trying to challenge the highs, and then we did have a sizable pullback until we did have that final move. But this also shows you how messy it is to trade breakouts, because let's see that you were a breakout investor and you went bullish here. You could have like a 5% move. Okay, 5% is decent, but if you were a bit more ballsy and you bought near the lows, just up here, that's 31%. And if you were a part of the breakout, you would have a 42% move. No, 41%. So yeah, so breakouts, they obviously matter and they are a clear bullish signal, but I do prefer to get in towards lows because it just works more often. So here's the seasonalities over the last 5 years. Quant tends to outperform the DVA, but then over the last 10 years, and also the last 7 years, we tend to see a bit of a pullback here towards later April. Here I am comparing the agriculture fund with the S&P 500, and we do have this major rounding bottoming formation here. So let me just draw that in. A massive rounding bottom. So long term, we could see agriculture, commodities outperform the S&P 500. Let's look a bit at the seasonality. Yeah, the seasonality here over the last 10 years in red is favorable to the bears. In blue here over the 7 years, broadly also here over the last 5 years in green, favorable to the bears. So looking very long term, it certainly seems like agriculture is going to outperform stocks going forward. Looking at the relationship between corn, however, and agriculture, there is a risk based on some prior history that we could see, grain, agricultural commodities traders sell out of their corn positions and buy into some of the more undervalued agricultural commodities. So I do think I will lean a bit bullish here, but yeah, I do end up with a 2. So we have a score of 0.5, so the data is more favorable to bullish theses than bearish. But to be perfectly clear, the best way to trade a breakout, that is by getting in early. Okay, so to enter a new position as the breakout happens. I just do not have good experience with that. Whatever you do, of course, you want to use stops and be market neutral.